How do manufacturing companies differ from other company types when it comes to costs and financial statements? Manufacturing companies use labor, equipment, supplies, and facilities to convert raw materials into finished products. They track costs using 3 different types of inventory. Raw materials inventory, which includes materials used to make a product. Work in process, which includes goods that are in the manufacturing process but are not complete. Finished goods inventory, which includes completed goods that have not yet been sold. Manufacturing companies have many ways of classifying costs, such as manufacturing costs. These include direct materials, the costs of raw materials that are converted into the finished product and easily traced to the product. Direct labor, the cost of wages and salaries of employees who convert the raw materials into finished product. And manufacturing overhead, the indirect manufacturing costs that are not easily traced to specific products. Take potato chips Inc., for example. The direct materials would be the potatoes, oils, and ingredients to make the chips. The direct labor would be the people peeling and slicing the potatoes, if this were back in the day. Now it would be the people running the machines to do that. Manufacturing overhead includes setting up machines, cleaning, managers' salaries, maintenance costs, depreciation, and more. These are considered product costs and are recorded as an asset and then expensed when sold. The opposite of a product cost is a period cost. These are non-manufacturing costs such as rent on the corporate office or the marketer's salary. These are expensed when incurred. Now let's look at some of the financial statements of a manufacturing company. The balance sheet includes the raw materials inventory, work in process inventory, and finished goods. These will all be listed as assets along with the cash, accounts receivable, equipment the company may have, and more. What makes the income statement unique for a manufacturing company is that it will include beginning and ending finished goods inventory and cost of goods manufactured. The cost of goods manufactured is found by following 3 steps. Step 1. Calculate direct materials used. To do this, you add periods beginning direct materials to purchases of direct materials. That total is the direct materials available for use. From that, you subtract the ending direct materials balance. Step 2. Calculate total manufacturing costs incurred during the year. The setup for this calculation is the direct materials used plus direct labor plus manufacturing overhead, which we discussed previously. So for example, indirect materials, indirect labor, depreciation, insurance, and property taxes. Once you add these, this will be your total manufacturing overhead. Add all of this and you will get your total manufacturing costs incurred during the year. The last step is to calculate the cost of goods manufactured. This will be the beginning work in process inventory plus the total manufacturing costs incurred during the year to give you the total manufacturing costs to account for. Then, subtract the ending work in process inventory to get your costs of goods manufactured. The last calculation needed to find the gross profit is the cost of goods sold. This is the beginning finished goods inventory plus costs of goods manufactured. That is the cost of goods available for sale. From that, you subtract the ending finished goods inventory to get your cost of goods sold. Those amounts are added along with ones we have previously learned about, and create the year-end income statement.